Join me now for more on today's sell-off and what is likely to happen tomorrow and beyond. Euro-Pacific CEO, Chief Global Strategist, Peter Schiff. Peter, good to have you with us. Peter is the author of the book, How an Economy Grows and Why It Crashes. And also with us, Moody's Chief Economist, John Lonsky. John, thanks for being here. Wall Street Journal Global Deals Editor, Dennis Berman. Dennis, good to see you. Let's start, Peter, this market selling off. I mean, it was wholesale today.
Yeah, you know, a president was right about one thing. You know, if Bush had been a better president, we wouldn't have elected Obama. So that part of it is his fault. But, you know, the market is selling off because people are finally coming to the conclusion that the stimulus didn't work. Recession is coming back, and people are calling it a double dip. I think it's all part of one big depression that was temporarily interrupted by the stimulus spending, but all we did is spend ourselves into a deeper hole. And I think we're facing a bigger economic contraction now because of the stimulus and the bailouts than what we faced before.
Even though that the macro numbers from the Commerce Department don't support that view, at least in terms of contraction. John, your thoughts?
You got to keep your eye on jobs growth. If we do grow payrolls by more than 50,000 jobs for the month of July, that would be a positive sign. That would tell us that at least we're not in a double dip. And I also think we want to consider that a lot of the downside risk has been exhausted by the beating this economy has already taken. Consider home prices. How much lower are real estate prices going to go in some parts of this country? Meanwhile, we're now looking at very low Treasury bond yields. We should have had a 2.25% Treasury bond yield in 2008. We did it. And I think because of this latest drop by Treasury bond yields, the 30-year mortgage yield is going to go to 4%, if not lower. And I will add that right now, BAA industrial company bond yields are at their lowest level since May of 1966, 45 years ago. So that's got to provide some support.
What happens when they go up?
Well, they may not go up because we're now looking at a different America. This is an older America. This is Japan-like.
No,
interest rates are going to remain under 3.5% for a much longer period of time than you imagine. Inflation's going no place.
No, inflation is going up.
No, it's not. Wages are going to go lower because of high unemployment after Labor Day.
Wages will go over. Real estate prices can go lower, but consumer prices for things like food and energy, they're going to go up.
They're going to be forced lower. They're eventually.
Dennis, today, watching these treasuries, I have to wonder what in the heck were all the ratings agencies talking about? What were these so-called leaders of ours in Washington talking about debt downgrade? I mean, the treasury market is flooded.
Well, they're not entirely related, as you know, Lou, but we have to consider what's happening in the global economy, and that is we are the least worst option right now when you have to consider where you put your money. Do you want to buy euro-denominated bonds? Do you want to buy a Greek bond, an Italian bond, a Portuguese bond, or a Spanish bond?
You can buy gold.
The answer is no. You can buy gold, but even gold, as you noted, retreated today.
Oh, half of 1%.
But we're in a situation now, Lou, where we have to assess as a country fundamentally how we regrow and restart and reshape the economy, because
well, that's all well and good. There's just one problem with that. We've needed to do that since 2007, and is by my count, we're 4 years into the process. I mean,
this is our fifth summer of crisis. If you remember 2007, that's when things started to crack. The subprime crisis, as it was back then.
My count, that was 4, but that's all right.
But government policy is getting in the way of the restructuring that we need. I mean, what's wrong with our economy? Too much spending, too much debt, too much government. We're doing the reverse. We need more individual savings. We need higher interest rates. We need to produce more. We need to export more. We're not doing any of that.
A more aggressive energy policy, to say nothing else. I mean,
free markets is the policy we need instead of government control.
The Canadians think nothing about going to the Alberta tar sands and extracting oil, and we're nervous about the North Shore of Alaska that's in the middle of nowhere. What about the development of natural gas reserves in New York State? Do they have to hustle up in those areas, bring the price of energy down, and that would provide a nice boost to the economy.
Well, the price of energy today did drop. As a matter of fact, as we reported, to just
it's still over $90, or is it?
Let me finish the sentence, if I may.
It's exactly where it was.
86. But the point being that it broke through 90. Why? Gold down over $7.30 an ounce. Why? Because those are counter moves to what we have seen as a massive sell-off in equities.
Well, people were selling everything just, to raise cash. There are a lot of people that are very leveraged in these markets, and they have to cut their positions. Maybe they got a margin call. Maybe they have some redemptions. So everybody was selling everything.
What happens?
I think the market goes up. If we have a number on the jobs report that is slightly better than the worst
John
expectations.
used 50,000, which is
abysmal when you consider hundreds of thousands of new college graduates coming into the job market.
Define a good unemployment number tomorrow.
Over 100,000.
I would say anything above 50,000 and an unemployment rate that does not rise from last month's 9.2%.
It's hard to say it from any one number, but I can tell you that we're not going to create jobs in this economy. We're going to keep on destroying jobs. I think the unemployment rate is going to go back above whatever that 10.1, 10.2% was the high, I think, in 2010, because we cannot create jobs until the government stops destroying them, until the government stops spending money and regulating businesses.
There are folks listening to you, gentlemen, right now, who are wondering about their 401ks. They're worrying about their portfolios. Because this is a broad market sell-off by asset class. What should they expect tomorrow? What should they be doing or preparing for? Peter?
Well, I think they should be preparing for inflation, the debasement of the dollar. What the Fed is going to do is go QE3. All they know is to throw gasoline on a fire. They're going to keep printing money to try to artificially stimulate all the problems in the economy. So people have to understand that the dollar is going to suffer dramatically. The cost of living is going to rise. And so people need to diversify themselves. They got to be in gold. They got to be in foreign currencies. They got to be in foreign assets. Otherwise, they're going to watch their purchasing power go up in smoke.
Yeah, when the Fed implemented QE2, stock prices soared higher. So if you believe that another 5% drop by equities will force the Fed into adopting QE3, then you should stand pat. And on the inflation front, by the way, I think we should remind the audience that during the Reagan years, core inflation averaged 4.3%. At last look, core inflation was only 1.5%. I think it's a little bit too early.
Yeah,
but remember, we changed the way we measured inflation
I think
Reagan and now. Oh, yes, they did.
You're wrong.
The Boskin Commission? Oh, it's night and day.
No, you're
now.
wrong.
I'd love to meditate on the Boskin Commission.
You get
but
the
I
last
think Peter
word,
has
but
a
it's gotta be a
good
quick
point
one.
that inflation is a long-term worry, but that is, in my mind, 5 years out.
Let me keep that in context. Those watching you tonight with their portfolios, their 401ks, what should they be prepared for tomorrow?
Don't panic.
It's a little late for
No,
that.
but
I wasn't thinking emotionally. I was thinking.
Stay the course, and if there are things you want to buy them now. Only three stocks in the S&P 500 actually went up. We can't assume that the market's going to keep falling at the rate.
But selling doesn't always equate with panic. Sometimes you have to sell, especially if you're holding the wrong thing.
The last word is going to be a long time coming here among these three. Thank you very much. Peter Schiff, thank you, John, thank you.